Welcome to Coleman Report Live. I'm Bob Coleman. We're talking Main Street and the small business lenders who help it grow. John Winnick's in the house. Clark Capital President, recurring guest. I guess we can bump you up to contributor now, John. Jeez, you're doing a good job.
No, I'll put on my LinkedIn profile.
I think you and I need to switch backgrounds here. You look like you're at the beach, and I need to be in the corporate office anyway. Delaney, good to see you. Thank you for joining us. Delaney's going to talk about Fraud Friday. Let's get into it. What's going on? I love having John on. He gives a little macro, but he also ties it in directly with what we're doing in SBA lending. John is an expert in terms of what all this stuff impacts SBA supply and demand. John, go ahead. What's going on?
Well, thanks, Bob. Inflation has been stubborn. There's been 300 basis points of rate increases, and that's all occurred in 6 months or so. And, still seeing pretty painful core inflation numbers. I think they came in, a little higher than expected. I think it grew 0.4 from the prior month. There's really two issues here. Well, one, the positive part is it's almost like we're too resilient. We were pleased with the resiliency of the American economy, American consumer, American small business in 2020. Now you kind of wish they weren't so resilient because, I gave an example. I thought that travel would start to peter out after Labor Day. That, the leisure traveler was getting their revenge travel out of the way. And I did notice that hotel rates and flights were cheaper after Labor Day. But no, Delta Airlines said yesterday that early this week that they're up, their bookings are up again. What we're seeing is despite all these rate increases, there's still strong demand. And, they're trying to get demand to, collapse, but to lessen, and it doesn't seem to be happening. The risk here is as these rates continue to rise, the vast majority of 7A loans, I don't know which percentage of 7A loans are floating rate. Is it 80% or so?
Oh, 99%, John.
And are they mostly quarterly? They're quarterly, right?
Yes. The answer is yes. Quarterly, just.
Quarterly. Let's project forward. Prime was 3.25 a year ago. So your max 2.75 deal was 6. And with the next rate increase that's taking prime till 7, you're almost at 10%.
Right.
9.75 versus 6% is a pretty big rate shock. And, certainly a lot of credits were underwritten with a 5 or a 6% interest rate, and now they have to service a 9 or a 10% interest rate. 9 or 10% interest rate ever met anyone's stress test, right? People were stressing it probably at like 6 or 7. So,
but John, all the anecdotal data I read and talk to people, delinquencies are still in good shape. Delaney just did a report last week saying, hey, the delinquencies are at acceptable historical low levels. What's the disconnect?
Well, I think part of that is the resiliency, but also some of that is the lingering effects of a lot of stimulus. People still have their PPP money, they have their ADL money, and that's become a cushion for some of these rate increases. You're seeing a little bit of early stage delinquencies in the consumer side, so they are up a little bit, but we're starting at near record low levels of delinquency. So look, you're definitely going to see an uptick in businesses struggling with these higher interest rates, but so far we haven't seen it yet. But keep in mind that these rate increases are relatively recent, and people may be fine for 6-7 months, and then the pinch starts to set in.
Delaney's been doing some interesting research and reporting. And again, Delaney, John made a comment that the demand for travel was higher than he expected. With all your reading, what do you see in Main Street? I mean, the demand is still there, isn't it?
Yes, actually, for a report that's going to come out next week, it was saying a lot of businesses are seeing higher sales.
So, and the other disconnect that I have, John, and I'm not smart enough to figure it out, but all the other economic downturns have been with high unemployment. We don't have that this time around. What's the problem that I'm seeing?
Well, I mean, again, it's a good, bad problem, right? I mean, the fact that the job market is so strong enables the Fed to keep raising rates. And so, you know, there is a real risk. I think the Wharton professor Siegel, his first name escapes me, warned today that if the Fed is basing policy based on core inflation, and core inflation could be 6 to 12 months behind, they could hike us into a depression. You know,
well, that's fun news.
You know, one guy in CNBC's opinion, but you know, that is the other side of this is inflation may be coming down. I mean, the housing market, you're seeing a 10% decline in those frothy markets like Austin and so on from their peaks. But it's going to be a while. I mean, really, the only thing right now that's showing anything resembling a recession right now is the housing market. And obviously, the title companies and the real estate brokers and the mortgage brokers all feed off the housing market. And you know, what we're likely to see is record low transactions for mortgages, for home purchases. People that have 2.5% mortgages are not going to sell their house because they're going to have to trade up to a 6.5% interest rate. And, you know, I don't necessarily think you're going to see a huge decline in home prices because supply may just continue to stay low. Right. And while demand comes down, supply comes down. So, yeah, it's hard to figure out. I'm not making any long-term predictions. I mean, I do think there is a lot of evidence that when inflation is this high and unemployment is this low, you know, a recession often follows. But, you know, I mean, nobody's been able to predict the last 2 years. So.
Well, again, for our small business owners, Delaney, you've reported that the number one problem isn't lack of sales, as you just said. It's getting qualified people in the door.
I mean, I tip I would give the small businesses.
That's a pause. I'm sorry, John. That's a pause that allows you to say, Bob, what a great observation. Yes, I agree with you. And then you get to add on and repeat it. So I'm sorry. That's how we do this.
My apologies.
Go ahead, John.
Now I lost my train of thought. But, I mean, I do think, yeah, one thing I noticed that I think small businesses should consider is, you know, even major banks like J.P. Morgan Chase are hiring people with criminal backgrounds. So, you know, the largest sort of untapped labor pool out there left is probably, you know, those with, you know, prior criminal convictions.
What was it, justice challenged or I don't know what the new code word is these days, but no, I agree with you. I agree with you. Well, it's fascinating. But I'm not asking you to predict anything other than let's focus on Main Street 7A loan delinquencies. Just take it down to that level with trouble with employees, trouble with service. We've all experienced that. Demand seems to be up, but supply chain issues. But what's it look like for the average entrepreneur on Main Street?
Well, I think you're seeing. I actually researched this a couple days ago. You know, what the rate increases are going to mean to small businesses. I mean, I think first off, I do think small businesses probably disproportionately have floating rate debt. And when you throw in kind of credit cards as being a source of working capital for, you know, your independent contractors and so on, you know, I do think it probably hits the small business owner a little worse. You know, commercial real estate investors, most of their debt is fixed rate, so the higher rates don't matter as much. But, I think when you have a dramatic increase in interest rates, we haven't had anything like this since the early 80s, defaults should go up. How much? It's hard to predict. I think a lot of banks are going to have to deal with this question coming up where, if you have loans coming up for renewal and they can service their debt at their old rate, they may have to do a concession. They may have to do a TDR and keep the interest rate at 5% so that the borrower can continue to make their loan payments. So it's less of an issue with small business loans per se because they tend to be fully amortizing in nature, so they're not coming up for renewal. But, your line of credit typically comes up for renewal once a year or every 2 years. And so, that's going to be something that bankers are going to have to be thoughtful on. You certainly don't want to push your borrower into default by, putting their interest rate at a level where they can't make repayment.
Last question, I know, and this is another story that Delaney's following. What's going on with downtown small business to supporting the high rises? And you're an expert in commercial real estate in urban areas.
Well, I think that the downtowns are slowly coming back. I've been in downtown Chicago throughout the pandemic, except for the first couple of months, and traffic is as bad as it's ever been because people are driving to work more than taking public transportation. But I would suspect that the small businesses that feed off of downtowns, a lot of them already didn't make it. I think the ones that have survived and repositioned themselves will only benefit as the downtowns become more vibrant. You are seeing after Labor Day an increase in usage of office spaces. But, I had a meeting with a friend of mine who owns a trading business. He services community banks, actually. And his office was 57th and I think 6th Avenue. So, the heart of Midtown Manhattan, right next to Carnegie Hall. And not only was he one of the only 2 people in his office that day, and this is a trading floor, I was the only visitor in the entire building. So, downtowns are certainly less vibrant, particularly the cities that have too many office buildings. The downtowns like Austin or Nashville, the newer downtowns where you have more housing are probably doing better. But the classic, Northeast, Midwest, older downtown is probably still suffering a little bit because people haven't come back to the offices at the levels they were hoping.
Changing subjects, John, came out, Live Oak was the leader in SBA 7A loans, 1.7 billion, 1,200 loans. Do you follow Live Oak? Any comment? Do any of those numbers shock you? That's probably the better question.
No, I know Chip and they've performed very well and have certainly got into areas where they have a lot of expertise. And if they didn't have the expertise, they went and got it. To me, the fact that they're number one shows, how small the 7A loan program is compared to some other lending programs.
Yeah.
Right? 1.7 billion for the number one lender. The number one mortgage lender probably originates $500 million a year or something. So, sorry, $500 billion a year. So, that doesn't seem, unique.
Well, congratulations to Live Oak, and we will get all those numbers out as well. Delaney, it looks like our friends over at a Christian monk in a monastic institute is going to spend some time in jail. But given that background, one more, Joseph. Given that background, anyway, I don't mean to steal your thunder. What's going on here?
I definitely can't tell you what they were thinking, but Mr. Brian Bushell, an Orthodox Christian monk who goes by Father, and Tracy Stockton, who's an attorney. Together, they applied for both EIDL and PPP. Now, there were valid businesses, some different foundations for charities, surprisingly a brewery, a couple other things like that. And so for the EIDL loans, they overstated expenses, revenue, and managed to get $3.5 million. And then on PPP, they inflated the number of employees, the payroll. They wrote employees that never existed and never worked there and obtained another $150,000. This is all alleged. I always need to finish it off like that, but.
And yeah, and where are they out of? Do we know?
Ooh, here, give me 1 second.
Yeah, go ahead. John, but these stories come up all the time, John, where it's, and again, character's the first C, but you would think it's someone who's, you know, a monastic.
I mean, it's hard not to slam the SBA a little bit for, and the industry for that matter, for really not seeing this fraud issue. Everyone knew what was going on. You know, you saw that there were 10 PPP loans happening in an apartment building somewhere with, you know, 6 units or something. And, you know, we all just kind of said, well, that's not our issue. It's, you know, it's someone else's. And I think the dollars for fraud are catastrophic levels. It's really just.
I disagree with you, John. I mean, they're large, but overall in the program, they're, I would say, within norms. Obviously, cases like this make headlines, but I think it's still at the end of the day, it is a minor dollar amount. And the good news is they are on top of it early, and they're recovering a lot of these funds. Let's go to New Jersey. This story bothers me. We have a CEO of a bank, and quote, this is, of course, the U.S. attorney. He used the bank as his own piggy bank, stealing from it to line his pockets and the pockets of his corrupt friends. But he was making loans, and it had a partnership in those businesses, right, Delaney?
Yes, that was part of the scheme. There were 2 examples specifically in this release. One of them was a partnership with a friend. They got about $1 million. Ultimately, the loan defaulted. And I guess you could probably assume they did not disclose any kind of relationships of any sort. Similarly, there was another loan with a family member. Once again, did not disclose their relation. Got over $1 million. That one, I'm not sure if it defaulted, but I have to assume so. It's not explicitly stated.
I mean, usually, you know, divorce, gambling, drugs. I mean, it seems odd that a bank CEO is probably making more than 99.9% of the public is, you know, doing such obvious.
Doing the things and getting kickbacks.
It's usually a motivation, something. You know,
yeah. The thing that sticks out to me, though, is he only got 14 months. So that's usually when you're the president of the bank, they like to put on big prison terms. 14 months is relatively low with some of the other sentences we've seen. So, which means he didn't really get a lot of money out of this.
Well, he certainly has to forfeit quite a bit, $5.5 million. It's a little bit hefty.
Yeah, that's too bad. Very good, Delaney. John, I enjoyed having you on. Let's get you on again next month. I enjoy your input in terms of what's going on a macro level and how that affects Main Street. Lance is doing a webinar next week. We just got guidance out on October 5th on new revisions for servicing and guarantee purchasing for PPP loans. Be sure and take advantage of that. And, of course, we're waiting for the new SOPs. John, thank you very much. Delaney, good job. Thank you for joining us today for Coleman Report Live and for supporting America's Main Street, one entrepreneur at a time.
Have a nice weekend.
Thank you for joining us today for today's episode. If you like today's content, hit that subscribe button to subscribe to our channel and click that bell icon to get notified about our latest videos. Thank you again for joining us today and for supporting America's Main Street, one entrepreneur at a time. Catch you next time.